Welcome to Regulatory Ramblings, Episode 4. Our guest today is Urszula McCormack of the law firm of King & Wood malfeasance, where she's a partner. Having been a practitioner for close to 2 decades, she's one of the region's most sought-after regulatory specialists. In addition to being a certified anti-money laundering specialist, Urszula is also a global digital economy lawyer who advises on cross-border and transactional matters. And with that, Urszula, thank you for joining us. Regarding the August 10th announcement of Invest Hong Kong collaborating with the HKMA on the CBDC vertical of the Global FinTech Fast Track program, I know you shared, and I'd like to share with our viewers, on LinkedIn, quote, you mentioned, sharing to amplify this excellent initiative, CBDC development requires the very best of new technologies to address security, interoperability, privacy, use cases, and trust. In practice, it's common for a very small group of vendors to dominate the discussion of what is possible to solve challenges and drive opportunities. At the same time, we know the depth and thought and innovation occurring in blockchain and smart contracts is more broadly is vast. Examples like ZKPs and bridging techniques often improve the debate on how we might rethink transparency versus privacy versus interoperability, for example. The advantages of CBDCs are clear, but I'm thinking, what about in currencies that already have sophisticated digital fiat payment capabilities? Is there an added value in switching over for the consumer? What's the incentive?
Well, often it can be a solution in search of a problem, and a lot of the CBDC reports and ruminations over the past few years have really sought to challenge, where and how CBDCs are useful at all, and what it is that we're trying to achieve by implementing CBDCs. So I bring a strong degree of skepticism when it comes to, CBDCs as being some sort of cure-all. Generally speaking, when we talk about CBDCs, we're talking about renovating the existing infrastructure for issuing and distributing money, that can take a variety of forms. A lot of the talk has been, in many Western circles around blockchain, but if you take ECNY out of mainland China, it's not based on blockchain at all. And so it's a more sophisticated system of, issuing and distributing currency, in digital form. But I think there's a few things that, keep coming up, So in a lot of the reports, I remember one from, Japan, for example, really emphasizing the role of cash, on an ongoing basis, or at least for the foreseeable future, and having alternative means of payment, at the retail level, of making sure that people have sufficient degree of privacy, that is all very important. Some of that pushes certain markets to moving towards, just wholesale or, institutional level CBDCs, so that they're solving problems, at that institutional level for interbank transfers or cross-border interbank or inter-central bank type arrangements. And that's things like, a good example of that is mBridge that Hong Kong is participating in with mainland China and Thailand and UAE, that we've had a great pleasure of being involved in. And, there you can see that some of that CBDC development makes sense because you already have a technological layer. People aren't necessarily passing cash to one another at that level, but you're making it more robust, better. You're looking at the ways of having a better system in play and having those bilateral and multilateral connections, in a good way. But I think what this initiative with the HKMA, is seeking to do is to look at this from a few angles. So, this is part of an overall initiative that I've called the Global Fast Track. And it's looking at it like lots of different areas. And you've got a lot of regulators who are involved to help move people along, scale, bring innovative products from offshore to Hong Kong and beyond, but right across from commercial banking through to payments, RegTech, and so on. And they've added CBDCs. And CBDCs, they've got sort of these 9 key areas that they are focused on. That's 8. And it looks at adoption at a retail and a wholesale level, looks at programmable money, interoperability, privacy, cybersecurity, FX and liquidity management, and offline payments. And a lot of that is also looking at some of the use cases, for making CBDCs useful. No one wants to invest a lot of money to something that's going to be dead in the water. And also banks are really concerned about issuing things that, are ultimately going to mean that they're disintermediated as well, which is not great from the economy. So I see this initiative as looking at both the sort of use case side, and that's through the adoption aspects of that focus, of those focus areas. But it's also looking at these areas that, we see everyone concerned about. And recently we're helping the banking industry with their response to the HKMA's discussion paper on the EHKD. And, we know that people want trust, they want privacy, they want the ability for the system to work by design and to protect data, not to be, leaking it, to be secure from a cyber risk perspective. But they don't necessarily have all the tools at their disposal. So I mentioned in that post ZKP, so zero knowledge proofs, there are others, but it can be really useful to aid the discussion around how you achieve these things that we all really agree upon, but don't yet have those mechanisms. And I think the unfortunate thing is that we do have some really fantastic vendors, fantastic technology companies that are really just amazing at what they do. They're really clever, they're really institutionally focused, they're looking at central banks, they're working really closely with them. And at the same time, I see all of this like awesome, phenomenal, interesting, weird and wonderful development that's working away outside of that sort of grouping, where I feel like there can be more of that coming through, those ideas, those, in some cases, still experimental technologies, but coming through. And I think that's why this is such an interesting, initiative to try and see more of that, innovative stuff come through.
A couple of things come to mind when I hear you say that. I'm not a techie, but having interacted with some providers of what conceptually, at least to me, seem to be cutting-edge technologies. Progress has been slow to get the banks to buy in. They seem to like the proof of concept. The hierarchical nature of many of the major banks in this town, they don't need to be named, suggests that it's very slow. Things go through multiple levels, so implementation isn't as swift as it is in Singapore, because there the state is really spearheading the process. The other thing is a lot of people locally don't seem that sold on it. That they point out to the cons of CBDCs that no one's so far. I think we can agree it's a work in progress, but no one's come up with credible proposals as to how to safeguard people's privacy and sovereignty. So they're concerned about it from that perspective.
Yeah, and I see that debate, rage the world over. The US, is a particularly vocal contingent, including within government, where, genuinely, opposed to the idea of central bank digital currencies. Places like Australia, there is no centralized ID. You use your passport or driver's license. Generally, you don't have the equivalent of a Hong Kong ID card as such. And so you've got really strong opposition. And, in the absence of a sufficiently strong value proposition, it's also right for people to think through, what it means for them and whether or not it's a good thing at all to implement if it feels like the people who benefit are not them.
So as lawyers have different degrees of sophistication in this matter, I think it's clear that they need to learn more. What's the takeaway? What do they need to learn? What do they need to understand about cryptocurrencies and digital assets? That it's there's some degree of remedial education a modern financial lawyer or compliance officer will need to go through, because this will be, part of their, this will be part of their portfolio. This will be part of their responsibilities moving forward. What should they know? What should they keep in mind?
Yeah, well, look, so I do think that, more and more, we need to be conversant in the things that surround us, and particularly in an increasing digitalized sort of, world. And, roll your eyes as much as you want, but, things like metaverse are important topics because they simply speak to the fact that there's more and more activity occurring in a digital arena. And so, whether that's how we interact with one another on social media, different communication tools, or it's how we create and transmit value, or even sort of locate our businesses, it's touching more and more businesses. It's touching more and more, job descriptions. And so what I would say is that having that sort of general picture and just reading from time to time from an open-minded perspective is important. There's plenty, of stuff out there that rubbishes, the whole area of crypto, metaverse, Web3, and so on. And you need a healthy skepticism, but you also need to bring that curious and open mind, because it is an area that, in many areas that will continue to stay. Crypto requires a crystal ball. It is moving, and it is moving at pace. And so, to give you an example, when we were doing ICOs back in 17, 18, we were telling clients I had to do KYC. And it wasn't because there was a prescriptive requirement on an ICO issuer at that time. We just knew, and there were also risks relating to sanctions and generally terrorist financing and so on. And clients would really tell us that we were completely off market, that we were, telling them to do something that was going to be expensive. But they thanked us years later, saying that the only reason that they were able to get that big VC investment or that partnership with the bank was because they did the KYC, and we've seen others shut out for not doing that. And so, our role as an advisor is to look ahead. What's the next wave? And so today, KYC is now a thing that people generally do, but when we look at things like DeFi protocols and decentralized autonomous organizations or DAOs, we're looking at the next wave, and that need to sort of continue to bring that crystal ball. And it's not just a crystal ball of stuff we've made up. There's ways to find what is coming. So there's sort of two key sources. One is what's going on at the transnational level. So what is FATF saying? What's the FSB saying? What's IOSCO saying? That will tell you a lot about the next 5-10 years of crypto regulation. But secondly, also just bringing your traditional knowledge and mindset of where regulators are going to care. So, today is an exchange doing suitability, generally speaking, not many, but, a lot of them are trimming back how high, someone can leverage up trades. So, it's starting, but so asking the stupid questions and then bringing that crystal ball is really important. And then finally, I would just say that, bringing a multidisciplinary approach to this sector is really important. So, I sit as a financial and data, and financial crime regulatory lawyer, but there'll be elements of tax, of competition that need to come in, and so making sure that you're bringing people on the journey and educating them as you go, whether it's for an internal in-house project or whether it's as part of an external facing team, also just means that you're just giving a much better service to the people that you're assisting, but also means that you're taking those people on the journey as well, those tax specialists, those competition specialists, those other specialists of the ride, and bringing them on that learning journey too.
Yeah, it's the FATCA approach. I concur. Multidisciplinary teams will be necessary. Any new technology has to have rules. I mean that was my position even when I spoke at the first on the regulatory panel of the first Hong Kong Bitcoin event in 2014, and again in 2015. But at that time, there were, there was one might call a libertarian fringe that was adamant that there be no regulation because that would cut a nascent industry down in its prime. The common sense response of most people was you can't be a member of the financial system. You can't be part of the financial system and play by your own rules, or none at all. Clearly there need to be rules, and in that regard there is a role for lawyers. But again, one wonders then, is the role of lawyers in this equation to write the rules up after the fact? Should regulators or even policymakers be spearheading this? Is this, given that this is so technical, shouldn't it be the techies that are in charge of the crypto regulators?
Yeah, they need to be part of the story. I do see, on some of the consultations that you see a really traditional approach being.
Because most lawyers aren't engineers.
What's that?
Most lawyers are not engineers.
No, they're not. Absolutely not. Yeah, and you see a lot of misconceptions in, what's going on as well. And you see the use of the same tools, right? So bring in a licensing regime, bring in conduct regulation, and away you go. You're all set. The tricky things that engineers, in my experience, tend to want to do what they do best, which is the actual technology development. And so having those at the table that are willing to do so becomes, more and more important. So, and there have been some good projects. The World Economic Forum DeFi Policymakers Toolkit was looking at that, for example, and, we focused on the policy approaches, but had a lot of people who were really immersed in the technology drive, the overall description, the educational component of that for policymakers. But I think that there is a degree of fear that comes with this. And it comes back to a point I raised earlier, that with the risk-based approach, you always have residual risk. And the question is, as something scales and as you have, grandparents, diving into crypto or the world of DeFi, and mass adoption, the need to regulate becomes heightened. My concern, though, is twofold. One, that you get to a point where you're shutting out, people from being able to access growth opportunities by accessing risk and make decisions for themselves, and you move to an overly protective environment where really anything goes wrong, just a bad investment decision, and boom, the institution needs to pay out. But also, secondly, a point you raised, which was around the creation of shadow markets. We're in a really different environment than we were with structured products and derivatives, where with structured products and derivatives, you could say that, look, if we trim back access, both, to just professionals only, but also in terms of the products that are available, take out some of the credit products, focus on FX and equity type derivatives, we'll create safer markets. And in that sort of zone, you didn't really have as many channels for retail investors to go and source, a credit default swap freely. It's really different in the crypto world. You can access an international platform, you can access a DeFi exchange. It becomes a different environment. And so I think the looking at how we regulate needs to come from a very different perspective. To create a safe market, say for Hong Kong, is it really to shut out retail? Like, not really, because retail will simply go elsewhere and you've done nothing to protect them. So I think really critically examining it goes back to why we regulate and therefore how we regulate. But getting comfortable that there's a degree of risk, and then if there is risk, how do we assuage that? How do we improve through education? It used to be prevailing wisdom, in crypto, world, where you don't leave your assets on exchange. You don't put in more than you can, foreseeably lose. And it was a different mindset at that time than there is today. And I think that, we probably need to see the pendulum swing back a little bit more as well to self-responsibility when investing on top of the regulatory initiatives too.
Well, yeah, people forget that, they think that their coins are safe in a USB stick in their pocket. They can still lose them. And beyond that, I think what you alluded to, what happened over a decade ago, the Lehman mini bonds saga, one does get a sense that the more developed the society, the more people expect regulators to ride to their rescue. And the SFC operates on the basis of providing information, but beyond that, it's up to people, and certainly this society was divided over it. Many people felt it was the typical Hong Kong mindset of wanting to get rich quick, but then you had certainly people that made a sympathetic case and said, look, if you're nearing retirement, can you really begrudge someone wanting that extra 1 or 2 or 3% yield, which could make a world of difference for them in their old age? So yeah, I've heard these arguments. I think no matter what the next scandal is, people will expect regulators to come to their aid and
Yeah, and look, I will say that there's a significant amount of scammery out there, and genuine charlatans, and some of those charlatans come from finance, and are genuinely sort of self-interested, and are very happy to make a quick buck and make a quick exit. So that risk is there, and that risk is real, and it is the role of regulators to keep an eye on that and to take appropriate, intervention measures where needed. So there is definitely a role, for regulators in all of that. So certainly, I wouldn't dispute that at all.
In recent years, we've seen an explosion of credentials, that there is an arms race in credentials, in compliance, and now more recently with an eye towards the world of crypto and fintech. For our students, some of whom will go on to the LLM programs in compliance and regulation and corporate and financial law, do you see any benefit in obtaining additional credentials, additional certifications? I mean, I'm not going to plug any of those providers. People can find them for themselves, but is there any benefit to that kind of specialized knowledge, or are we just talking about an arms race of credentials and people putting letters after their last name and padding their resumes, or clearly some are better than others. In some programs you learn more than others. I mean, the online fintech program at HKU with the 3 modules leading to the certificate is completely solid. And I can vouch for that. But what are your thoughts on credentialism in this space? In a field where it's still relatively emerging, no one can few can credibly call themselves experts. People want to stand out and carve a position for themselves, and credentials seem to be the way to go.
Where I find undertaking that sort of deeper learning is useful is either at a broad level where, you want to know that you have a decent working understanding of a particular area. And, it could be anything. It could be trade finance, money laundering. It could be, how the Bitcoin blockchain works, or, plethora of crypto assets that are out there. And, that sort of broad working understanding of that, so that you have some context when you hear it again in a given context. And I think that can be a useful thing where you've got an interest, or where you've got a live opportunity, or you've got a particular role that you're looking to achieve. Not so much that an interviewer, for example, will see that on your CV and go, wow, I found the specialist, but that they can have a conversation with you, and then you'll be able to speak sensibly about a topic and about something that you are interested in, and where you can connect. And that will be the most telling thing to the person that you're dealing with, that something about that. The second area where I find it's useful is where you might, after a period of time, recognize an area where you feel you either have a blind spot or would really greatly benefit from having some deeper knowledge. So, there was a book that I looked at that was all about encryption and in blockchain. Now, it was very much for people who are investigators, auditors, who are in that. But for me, after working in this arena for a while, I felt there was a gap in my knowledge of just having some idea of what is going on at a really fundamental technological layer, such that it, assisted me to have better, deeper conversations with my clients. And some of that was the deeper dive on those techniques. Some of it was also just doing things like looking at blockchain explorers and just jumping around and looking at different transactions and following trails of movement and so on. And structured courses can also have a really good role to play in that. But again, you would only do that as a credentialed thing and, for the certificate if it was required. I would only, otherwise really do it for the journey, the supplementation of your knowledge, what it aids you to do because of having done that study. And that's where I think being really critical about what it is that the course delivers to you, what its subject matter is, who is speaking, and the opportunities for engagement, I think are really important to check.
Yeah, I mean, it in certain fields, and I think you can attest to this, certain credentials are absolutely required. If you're going to work in data privacy, you've got to get CIPP. AML, you may have the ICA diploma, you may have, you may be a certified financial crime specialist, you may have CFE. You've got to get the ACAMS credential, and again, there's no guarantee the CAMS credential will get you the job. But I mean, more often than not, it's got many candidates the interview.
Yeah, and it speaks to a certain level of, core understanding of concepts, of issues. So, that it definitely has that role to play there as well. We're starting to see, we had a conversation most recently with one of the regulators around how the exams will change for people who are licensed under the new bill. And, what the Hong Kong Securities Institute, are they building their programs to, stamp that the responsible officers have the knowledge that they need? So, that does make a lot of sense. Absolutely.
I want to ask you about the nature of compliance. And again, this seems to be a generational divide in that you have older compliance people say that compliance, governance, and risk management are not necessarily the same thing. They're interrelated. But risk management, compliance is all too often being used to do risk management because compliance entails investigations, which are an after-the-fact exercise, and it's a backward-looking proposition because you're looking at malfeasance once it's already happened, and legal and compliance are trying to figure out who did what, when, and who's to blame. Risk management is very much forward-looking. I mean, is it fair to view the compliance profession through such a paradigm, or is it too antiquated? I mean, what would a more holistic approach to compliance look like? Because, I mean, younger compliance officers tell me that when they enter a scenario, they enter a particular milieu, that everything has to be tailored for that locality, for that market. And so before they even devise the compliance program for that unit, that branch, they do a risk assessment, or that market, they do a risk assessment. They take a more holistic, more intertwined approach to it. As I can see, they're both right, but perhaps the older generation seem to be taking a more compartmentalized view of compliance. And some might say that that is what has been killing compliance, that is what has permitted the loopholes. Again, I won't name institutions, but I know that over the last 5 years, many older veteran compliance people at the major banks in this town have left because apparently the rumors, the stories we hear are true, that the internecine warfare between departments, the turf wars, the siloed structures are very much true. And yes, when an institution is young and growing, you want people to be hungry, and a certain amount of infighting is okay if it increases, the overall pie, if it forces people to work harder. When an institution reaches a certain level of maturity, though, it seems to me that that's toxic. And that clearly affects compliance. Because if you're a launderer, if you're a criminal, you will leverage different asymmetries, different weak points in an institution, and you will funnel your funds through those weak points. So what again, we come back to how do you look at what's a healthy approach to compliance?
I suppose with compliance, it needs to be part of a really structured approach to risk governance and risk management. And governance being, the people who are involved, right from shareholders, board directors, right through to senior management, compliance and risk professionals. But then also in terms of the, risk management structure, when we're looking at, there's a few facets to it, the risk appetite, at a fundamental, organizational level. And that actually drives decisions quite significantly through an institution. So if I'm working with a particular bank, on, whether it's some, weird and wonderful new project or it's a simple compliance build, on something that is just traditional regulation, understanding where their risk appetite lies is so important. Then there's the risk identification analysis and, prioritization, and that will need risk professionals, involved in that, but it'll also need business. And then it comes to sort of risk management, risk monitoring, and so on. And that's, where compliance delivers the strongest part of their value. But often, if that's all the role is, in terms of execution of, completing those checklists, you just waste so much of that value. And so the organizations that do it best will hear from the compliance teams where there are inefficiencies or where there are things that will slip through the gaps because of the approach that's taken. And if things are designed, whether it's by compliance or legal or, whomever, that don't make sense for business, then that needs to feed through as well, because you don't want a situation where frontline keeps blaming compliance and then tries to get things through, on the sly either. So all of those things are really important, and so having compliance really part of the fabric.
Certainly, those people in the financial world, be they in compliance or in-house security investigations, that come from law enforcement backgrounds, they see the secrecy related to crypto as protected criminals, because they're coming at it, as I shared with an earlier guest, Henri Arslanian, they're coming at it with the copper's blinders. Their perspective is, everyone's guilty until they've proven their innocence to me. And what manner of chicanery is this? Why does the average person need this level of secrecy if you've got nothing to hide? But again, that's how they're coming at it with their law enforcement or their military or their intelligence services backgrounds, and that's how they look at things. But
well, look, there's some fair perspectives in that. There's no doubt, crypto and, whether it's tumblers, mixers, unregulated exchanges, are being misused. But, to demonize, certain privacy enhancing or privacy preserving things, is on its own track to having its own poor ends. And I had a really interesting conversation with one of the people involved with one of the prominent privacy coins. And we had a great conversation around privacy and the importance of privacy to actually help prevent crime in an era where we have so much data flowing around very freely within, organizations, being asked for a selfie for, a very simple low value payment product, swapping credentials, having them lost, we're almost, kind of don't care anymore. But, that in itself means that identity fraud is so rampant. We've got other forms and typologies of crime emerging because of the oversharing of data. And I think that's why there's so much, so many good things coming from technology tools like zero knowledge proofs that simply confirm certain information and don't necessarily need to share all the underlying information, is that, it helps us minimize the data that's going through, and, it helps preserve really legitimate concerns around privacy. So a lot of people, will say, well, Bitcoin's horrible, it can be used by criminals. That's less true now with analytics. But Bitcoin, once you know a public address, you can see all the transactions. So it's like having someone's bank account number and all of their transaction statements, available to you. So there is a sweet spot. I don't think anyone argues in favor of full anonymity. I'm sure some people do. But, privacy is a different thing.
Yeah, I mean, look, I can't completely write off these ex-cops as curmudgeons because, I mean, they have a point that with the blockchain you can do point-to-point navigation. You can see where the funds went to and from. You know the quantum of the transaction. You know what the amount is. It doesn't tell you who the individuals in question were, or their nationalities, or their families, or the countries they came from, or their industries or professions. And as we know, all those factors go into fitting you into a risk matrix profile at most financial institutions. The other thing that that strikes me about this is that anonymity only goes so far, in that at some point the off-ramps of the world of crypto do merge into mainstream finance. At some point you will want to convert some of those funds into regular fiat currency. At that point your identity is going to have to be disclosed. So yeah, that
Well, an excellent point. So, that can help us work out, where do we direct our efforts? Do we need to be really thinking about the likes of people trading digital baseball cards, if it's the case that that's all it's for, or is it okay that, people, and frankly even criminals, trade digital baseball cards, and then but we do care once it's sort of, we've got the other, we've got stages of money laundering kicking in, so there does need to be a little bit of sense in working out where we focus our efforts. There's no doubt that we can be doing AML controls so much better than we are today, and it's a really stubborn. It's such a stubborn problem with so many critical underlying issues. We might sort of fob it off as just money flowing around, but the real, it's whether it's drugs or human trafficking or wildlife trafficking. It's some really significant real issues underpinning all of that.
Yeah, I mean, I wanted to ask you. I mean, do you think NFTs are a scam, or do they have some utility?
Yeah, look, I guess I see. So we first started looking at NFTs coming out of game platforms, and they were initially looking at launching utility tokens, payment tokens that they could use within their gaming ecosystems. But then, some of them had inbuilt NFTs, and NFTs are simply just unique things, unique tokens. And in the gaming environment, it could be, a car, a skin, some sort of, other in-game asset. And so within that ecosystem, that has some value for users to have. And someone who earns it through gameplay might well be keen to share it with somebody else when they no longer want it or need it, or because they feel like there's some upside in doing so. There is a really strong degree of controversy within the gaming community around whether or not NFTs are a good thing within that environment. But I think that they showcase, where NFTs can have value in a particular ecosystem. Outside of that, though, I think one area that, I quite like is for those creating, good digital art, and, there's a lot of really terrible digital art that's out there as well. It does mean that you can embed certain things within, the NFT in terms of the rights that are granted, in terms of the operation of the system for transactions, where you do have a flow of royalties back to the original creator, which you don't do, you don't see in the arts generally. And I see that as a real focus for those in the artistic community and who are trying to do things, whether it's with emerging artists, or with big artists, or with people who come from underprivileged sectors of society, to try and change that approach of people only becoming rich after they die, in their estates. So I do see some benefits there. Aside from that, in terms of real world, you have things like having a diamond on ledger, so that you can assist in checking provenance. So, every diamond has its own fingerprint, and that can assist, with things like that. You might have a car that, with a serial, number that's there and is used by the car company if there's a recall. So there's definitely a number of valuable use cases to it, but there is so much rubbish. And I think one of the good thing about boom bust cycles, is that you see a layer of froth that just disappears overnight, or at least is reduced significantly, which means that the industry can carry on as long as they're not, severely exposed, but can carry on at a bit of a better pace. Just like we saw in 2018, 2019 with the ICO, boom come off, many people felt like that was a really positive time for the industry. And I think that's what we're seeing now with, yet another crypto winter, that we've got a little bit more sort of time, quality, some of the hype coming off, some of the, good, healthy skepticism coming back to focus on good projects.
Some might say it's shades of the dot-com bust. I mean, because at that point you saw which companies had real technology behind them, and how many others had good concepts. But no, the technology wasn't there, or at the very least, they weren't capable of developing it. Urszula, thank you so much for your time. Please come back again.
Such a pleasure. Thank you for a really, really wonderful discussion.
Enjoyed it.